What happens to the markets and your investments during wartime, when wars break out, and the immediate and long term period afterwards? My name is Matthew Angel. I'm a certified financial planner and owner of Angel Legacy Advisors. I want to talk to you a little bit about what may be happening inside of your investments and maybe answer some questions about what happens in the markets in the immediate outbreaks of conflicts around the world and what we can learn from history. Got a couple of articles I want to be walking through with you to help us grow in our wisdom so we can manage our wealth better. The first article that I want us to walk through is called What Do Markets Typically Do in Times of War by endow.us. And what tends to happen is a couple of different things. And you can't always apply these rules across every conflict and every situation. Also, I'm not a seer, I can't see the future. So we don't know exactly what's going to happen with this current Middle Eastern conflict, but some things that I want us to look at. Going down on this article a little bit shows how markets have reacted to wars and geopolitical events. So if you look at large company stocks, large cap stocks over, from 1926 to 2013, average about 10% annual return. Small companies obviously do a little bit better over the long run. And then we're seeing the bond markets as well. Now, for each of these four major conflicts, World War II, the Korean War, Vietnam War, and Gulf War, on average, they tended to outperform the market. But what tends to happen is right when those geopolitical events happen, it increases the uncertainty in a specific situation and the markets react. We've absolutely seen this through the first quarter of 2026 as the conflict in the Middle East has spun up and there's concerns about what this is going to do to impact global oil prices, as well as a whole multitude of other things. As an investor, sometimes we want to figure out something that kind of makes sense in our brain, and we don't always attribute all of the different factors that could be moving your specific portfolio up or down. I want to share an article with you by Ari Van Gimmeren, and he does like a newsletter through Substack, which is really interesting to me because he looks at trends back in history and how they might apply today. So, in looking at his specific article, there are, immediately what can happen is fears, right? And here's that same chart again. Every major conflict, there's a little bit of a sell off in the beginning. You see markets go down and then followed by a recovery that sometimes takes some amount of time. He's calling out here that takes about 22 days to go to the bottom and about 47 days on average for all of those geopolitical events to recover. We've seen a little bit of this trend already with the markets dipping downwards in February and March, and then very recently beginning to rally. I wanted to go through each one of these and call out a couple of these. During World War I, there was a significant decline in 1914. So we're over 100 years away, where the Dow fell roughly 30%. And it was they actually closed the markets for 6 months period of time. And it was trying to stabilize a drop that happened over time. Okay. It was a catastrophic seeming moment. The markets closed, wars engulfing Europe, but it produced one of the single best year returns in history. So up 43%. If we go down to World War II, I want to call this one out for you. So counterintuitive on the first day. Hitler invaded Poland, September 1, 1939, and that event started the war. And then the markets shot up. Well, why would that happen? What investors do, whether it's equities or bonds, oftentimes they price in the uncertainty. At that period of time, it was widely felt that there was going to be some sort of conflict breaking out. And it broke out. It wasn't maybe quite initially as bad as some of the prognosticators thought. And so having some clarity on what's going to happen oddly enough, even if it's bad news, can shoot equities up. And then there's a third one. I want to go down here to the Russia-Ukraine invasion. So when Russia invaded Ukraine in 2022, the S&P actually gained 3% the first week. And widely, the reaction, there sometimes is movement inside of your investment portfolio, but it may not be connected to the war at all. That 2022 market decline, where equities went down, bonds went down, was really driven by a combination of things: really high inflation, as well as the Federal Reserve really aggressively hiking rates to try to curb that inflation. So the war didn't really have a huge amount of impact on the financial markets, even if it created a lot of concern and fear, not only with our allies in Europe, but in the United States. So, what should you conclude about what to do next in your specific situation? When I'm working with clients, we help devise long term strategies, whether they are accumulating their wealth in their 40s and 50s and even their 60s, or they're in retirement and they're drawing down on their portfolio to live on. Those long term strategies are really, really important to remember, that we may not want to react to something that is happening in a February, a March, an April, and a May. Those shorter term time frames, I'm typically counseling clients to remind them what's important to you. My family is important. Serving God is important. Having enough money and security so we can enjoy the blessings that we've had, on top of saving some of those funds to live on in the future and even giving some away. Those values really should drive your plan. And then your investments help serve that plan, not the other way around. So if you've noticed and checked your 401k balance or your brokerage account or any sort of investment portfolio that you had, checked it in February and March, maybe kind of red, looking down, and things are not looking as great. If you just now checked it in April 2026, you've noticed that a lot of those losses on paper have recovered quite a bit. If you are working with a good financial professional, they also are not just helping you with the psychological approach to investments. We also may need to be making moves during that market downturn. It can be a great time to consider Roth conversions when equities are down. It can be great to consider doing some tax loss harvesting, which is just a fancy way of saying that we're selling some securities when they're low. And or you may want to be rebalancing your portfolio. For a rebalance on our portfolio, that might mean that any equities you had in large cap companies, maybe the S&P 500, any investments that you've enjoyed a really nice gain through 2025, this might be a good time to rebalance and bring those back into your asset allocation. In some cases, moving money from stocks into bonds, and in other cases, we're moving from bonds into stocks while those securities are depressed. What I really want you to learn from this is that we should not draw our piece around our financial plan from what's happening in the markets and what's happening around the world, but tying it back to the things that are most important to you, building in strategies to help mitigate the risks, and ultimately trusting the provision that comes from above. Again, my name is Matthew Angel. I work at Angel Legacy Advisors. If you're ever interested in working with a financial professional to help guide you through these waters, there's information that you can go to at www.angellegacyadvisors.com. Thanks again. Have a great day.